Hello fellow investor, curious about investing with Sarwa? In this video I will show what your return will be, and trust me, it will surprise you. I'm really going to dig into Sarwa. We'll take a peek of how Sarwa works, break down their investment portfolio to see what will be the exact return you will get, and as a bonus I'm going to show you a cost-effective solution to get the same result as Sarwa but avoid to pay hundreds of dollars in fees. As usual, everything in the timestamps. Let's begin. If you are unfamiliar with Sarwa, that's one of the most commonly used robo-investor for the Middle East region, but also for basically any other country apart from the United States. The goal of Sarwa is to make investment easy for everyone. You don't need to learn about how to pick stock or how to invest. You just decide what is your budget, what is your level of risk, and that's it. Sarwa take your money, and according to the plan you choose, they invest this money in some ETFs. You can see on their website there are different plans right here and different level of risk. You can have a lower risk that is more exposed, for example, for bonds because are less risky, and from the other side, if you move to the more risky portfolio, they are more exposed to stocks. The problem is that no matter the one you pick, the return is not gonna be great. This is the juicy part of the video. Everything you will see right here you can find with link into the description, so you can take your own conclusion. As you can see right here, they have 5 different portfolio: the conventional one, the halal portfolio, the social responsible one, plus they have the conventional crypto, which just add 5% of Bitcoin, and the social responsible crypto that also add 5% Bitcoin to the social responsible one. For the purpose of this video, I will take only the conventional one. Why I choose only the conventional one is, first of all, because it's the one that is most widely used. Also, it doesn't change much comparing the halal and the social responsible. Your investment is split across 6 different types of investment. For each type, there is an ETF. If you dig a little bit into the help area of Sarwa, you will see that they tell you exactly which ETF they are going to use. I decided to create my own Google Sheet table, and I will start to dig into the 6 ETFs. So these are the 6 ETFs. You see the type of investment is written right here. You can find the ticker of the ETF. The company that manages the ETF basically is for all of them Vanguard, apart from the developed market that is managed by BlackRock. The expense ratio of the ETF, this will be very important a little bit later. You see they are quite low for all of them, apart from the real estate one. The beta of the ETFs, in this case only for the stocks ETF, and the annualized historic return. This is the annualized return from inception of each ETF. You can find all the information in the link right here that I link directly to the website of Vanguard or BlackRock, so you can see that the information I took are exactly the same of the website. Let's analyze the 6th level of risk of the conventional portfolio. This is my comparison. This is the 6th level of risk. Risk 1 is the lower risk. If we go again here, is exactly this one, while the risk 6 is the more risky, and is this one right here. Percentage as the same as the Sarwa website. After that, we can draw our conclusion. We can understand what is the average return. This is a weighted return according to the different percentage, and we see that the risk 1 give a 2.52% return, while the higher risk give a little bit more than 6, almost 6.50. Remember, such return are not guaranteed, are just statistical data. We can assume that on the long run, and for long run I mean 5, 10, 15 years, not a couple of months, the return you will get will in some way be close to the one that is represented here. When it comes to investing, please remember not any return is 100% sure. So we have our average return right here, the expense ratio that is also weighted across the investment. You can check the formula right here. And this is the net investment return. And this is the ugly part. We need to deduct the Sarwa fee, which is extremely high. As we can see right here, this is the price model of Sarwa. So if you have your investment under $50,000, you pay 0.85% of the full amount you are investing. So it's not only of the profit is on the full amount, it becomes 0.7% in case your balance is at least $50,000. and 0.5% if your balance is more than $100,000. I make this analysis thinking about less than $50,000 because I believe that many of you are in this situation, but you can download the file and you can change the value right here and things will change. So if we remove the Sarwa fee that, remember, are removed every year, and doesn't matter if it was a positive or a negative year, you will lose 0.85% every time. It's just priced inside the value of your investment. And you see the ugly truth right here, and believe me, it's really ugly. Investment risk 1 give less than 2%. This is a waste of money. If you choose a conventional portfolio risk 1, you are throwing away your money. If you go to check in Sarwa, there is even the possibility to invest in cash they call saving, and the guarantee here, and this guarantee by Sarwa, 3% per year and 0 fee. So you can understand that basically these two are completely useless. What you will get with this investment is much less you can get giving the money to any bank account. They will make a better return for you right now. Risk 3 and so on, the situation become better, but the top you can arrive is basically 5.5%. Which is not that nice. Nowadays the market can make you much more. I will show you with this forecast right here. I took an example of $10,000 investment. Again, you can download this file, you can change this value right here, and you can customize according to how you plan to do your investment. And I'm making a span of 15 years. So the investment is the same for all the 6 type of risk portfolio, and these are the return you get. And I put on this chart right here, you see that basically this light purple one is risk 1, and they go up to risk 6, that is this one. Basically, if you invest $10,000 on the riskiest composition of the portfolio, after 15 years you will get $22,000. So you will more than double your investment, but as we said, the return annualized will be 5.56%. And after I take the freedom to add 3 different type of investment that in my opinion are quite easily to get for everybody, and you will see that they generate a much higher return. The first one is the T-bill, a US bond at $20. I know this is not easy to invest in a US bond, but this is the value of investment under which you should never go. If your investment return less than US bond, you're doing something wrong. At the moment I'm recording, the T-bill at 20 years, it gives 4.38%. Which is the line dotted right here, the one in orange. So you see already that investment risk 1, 2 and 3 are useless. You put your money in Sarwa with level of risk 1, 2, 3, you're wasting your money. After I took a normal S&P 500, I took SPY, which is probably one of the most common ETF you can find in whatever stockbroker you are using. It can be Sarwa Trade, it can be Baraka, Interactive Broker, Saxo Bank, whatever you are using. You can find SPY or VWO. There are so many that invest in the S&P 500. I will probably make a link into the description to some of them, which give a little bit more than 9% in average. And you see this, the red one right here, it's completely another scale. Basically, with zero effort, you can get a return that is much better than Sarwa. And it's pretty easy to invest. It's just one ETF. Just put your money in one ETF. After I take also the freedom to add the same investment the Sarwa suggests, but without the Sarwa fee, without the 0.85%. And you see the difference is quite visible. Okay, it's not good like investing in SPY. So if you want to remain with the same level of risk that Sarwa is proposing, anyway, cutting out the fee of Sarwa, it makes a very good difference. It passed from $22,000 after 15 years up to more than 25. It's quite considerable amount. These are money you are giving to Sarwa just because you don't want to spend, I don't know, 10 minutes a month to set up your investment. And this is why now I will show you, it's a very simple solution to make the same investment of Sarwa just without paying their crazy fees. This one right here is my Trading 212 account. Trading 212 is a very popular stockbroker, mostly used in Europe, but you can use from Middle East or many other countries. I'm using this right now because it gives the possibility to create what is called a pie, which is a sort of portfolio exactly like Sarwa is doing. You select stocks or ETF you want to invest in. You decide how much percentage of your investment go in different ETFs, and it will invest your money automatically. So it's doing exactly the same of Sarwa, just you're not paying any fee on Trading 212, which is quite great. So let's go right here. I have one of my investment. They are called pies. This is I will leave a link into the description. This is an investment I started a long time ago, almost 2 years ago, and it's basically done on 3 different ETFs. But let's create a new pie right here, and we try to create a pie that in some way go to match. Let me go right here, this one, the risk 6 of Sarwa. It will not be exactly the same because on Trading 212 I don't have the same exactly ETFs like this one right here. Unfortunately, Trading 212 is more focused on ETFs that are listed in Europe. This one of Sarwa are all listed in the United States, so there can be some differences, but at the end the return will be much the same because the underlying stock are the same. So let's go back right here. Let's search. First of one need to be some sort of total US market ETF. I will take an S&P 500 ETF, which is a little bit better performing. Let's search for an S&P 500, and let's take this. Let's take one in dollar. This one right here. This is listed in London. And let's add. After we need a developed market. Let me see what we have. Developed market. Let me take a developed world, for example, this one right here. Let's go on with a real estate one. Real estate. Vesco, that this can be. This is basically an ETF focused on United States real estate. Let's add it. After I want an emerging market. This one right here can work. Again, I'm not choosing exactly the same. I know I can do much better if I dig into that, but I just want to show you how easy it is. And let's go on to US bond and global bond. So let's search US bond. Let's go to this one, US aggregate bonds, and after the global bond. So global bonds. I share corporate global bond, this can be. So we have our 6 ETF that in some way are similar to the one of Sarwa, and let's try to replicate the same distribution. So US stock, let's go, on this one. US stock are 41%, developed market 36%. So US stock this is a very similar portfolio to the one of Sarwa. We give a return bigger than 8% according to Trading 212. I didn't do all the digging, but I suppose the information are quite right. Let's call it Sarwa Risk 6, no fee, because here we don't pay any fee. We choose a nice icon right here. Let's choose this pig that I like. And let's go next. After we can set up the automatic investment, so we connect our card and we transfer automatically every month the amount we want, or we do it manually. For the moment, I do it manually. Why is right here? This is the holding, same percentage of Sarwa, and you basically just need to put money into that and you save 0.85%. So you see, it's really super simple. You can do in Trading 212, you can use another broker. Maybe if you want to have exactly the same ETF of Sarwa, it's better to use a broker that let you trade stocks and ETFs in United States. So for example, can be Interactive Broker, Baraka, Rasid, even Sarwa Trade, which is the other side of Sarwa that let you trade stock and ETF directly. It's super simple to do it, and you save a lot of money in fees on the long run. If you arrive up to here, probably you already understood my point of view on Sarwa. This is a great system for people that are, let's say, lazy, that don't want to learn about investment. But if you don't choose correctly what you're investing your money in, it can be a value trap. Also, asking 0.85% as a fee is not correct from my point of view. At the end, Sarwa is like a passive managed ETF. Just take your money and invest in 6 separate ETFs. They don't do any research, they don't do any analysis, it's not actively managed. If you take Vanguard or BlackRock or this kind of ETF manager, for such a passive ETF, they charge you something between 0.1 or 0.05%. And this is, let's say, more than 10 times lower. If you really don't want to dedicate 10 10 minutes a month just to set up a correct investment. Okay, use Sarwa, but please avoid at all cost the low risk portfolio, because these are really a waste of money. Go back in the video, see where I was talking about the portfolio and choose wisely. And if you don't know what to do really, it's better to put in a cash account and get at least the 3%. Thank you for watching. Let me know what you think about Sarwa in the comment. If you agree with my conclusion or if you have a different point of view, I always try to reply. Subscribe to the channel if you didn't do yet, because it really helps a lot, and see you to the next video.